Good afternoon. Thank you so much for coming up here after a lunch. I know it's hard to clear that room out, so I appreciate it. We had a good speaker earlier today on real estate. I don't know if those were in here got to listen to Paul from Intercontinental. He did a very good high-level overview of what's going on in the country in and around at the highest levels. I'm going to drill down very, very granular, and I'm going to get into very specific markets and talk about what I would refer to, I guess if I were to title this whole thing, in addition to the title you see there, is the title of multiple cities. So not the tale of two cities, but the tale of multiple cities. Because there's definitely extreme differences going on in one city that may be a lot more popular than other cities, and the effects that are happening in real estate are pretty amazing. So we're going to start out by talking about the topics here today. A lot of the stuff I'm going to talk about is what drives real estate value, short-term and long-term. So we'll start by talking about migratory trends and the importance of those trends. Basically understanding where are the people going in the United States and why. What is driving the migratory trends? What's driving the corporate relocations? What's going on that's creating this excess demand in certain markets that allow us to push lease rates, even in some cases at alarming levels, to create value or increase net operating income. Because that's what it's really about, is if you don't have the demand, you can't ask for more rental rates or more income at the property level. And if you don't create more income, then you're not creating value. So those markets that are flat to no growth markets are not creating a fraction of the value that can be created in other markets. So the migratory trends are important, but most importantly, why do people go certain places? What's driving that? Cost of new construction, we'll talk about that. It's gone up at an alarming rate over the last 7 years. We'll get specific to that. Core markets struggle. Some of those larger markets that are dealing with a lot of different things that were also considered during COVID more vertical markets, because a lot of people working and living in taller buildings, meaning sharing elevators, sharing workspace, and so forth. There was a movement over the last couple of years where people were reevaluating a lot of different things, not just cost of living, not just taxation, but the awareness of being around people and maybe wanting to live in more horizontal environments as opposed to vertical environments. Those things were driving some things away from the core markets. Also, people and businesses, I mentioned, in general, families, they not only seek affordability, but they're also seeking safety and security and political stability. So these things we'll talk about. And then a residential outlook, and we'll talk about some case studies of certain asset classes in certain markets that will really are pretty eye-opening. And these are assets, we know the details because of these assets, because we bought them, but we bought them for certain reasons. And some people would actually have even questioned, why would you have bought something like Class A office in October of 2020? Well, people are saying, why would you do that? It's not why would we do it, it's where did we do it, and what did we know what was going on in that particular city that drove the potential for the creation of value. So those are the things we'll talk about. Tale of multiple cities. As I mentioned, you want to invest where there's constant growth and demand. You want to avoid flat to no growth markets. The top 5 demand drivers, okay, that you always should pay attention to are, where is the top level employment growth happening? Where do you see most employment growth happening? And then where is the population growing the fastest? And then where are the corporate relocations going? Businesses are moving to seek affordability, but they also want to be in places where their employees want to live and can afford to live. So they think about all the things, corporate taxes, business-friendly environments, so on and so forth. And then the financial strength of a state or a submarket. So you want to be in a state that's actually growing, or a city that's actually growing financially. Because business leaders who are making hiring decisions, they want to feel comfortable and confident that that state and that city is actually growing, because they're going to invest more dollars into buying more office buildings, or renting more office space, or hiring more people, or paying higher wages to be competitive. So they want to know that market or that submarket is strong financially. So those things are important. And of course, cost of living and taxes. So without these consistent demand drivers, you can't really put together for lack of better terms, a constant thematic strategy that you can rely on from a programmatic perspective, meaning deal in, deal out, year in, year out, fund 1, fund 2, fund 3, fund 4, up to fund 10. You have to have some type of underlying program or thesis and strategy that's consistent. So it's more programmatic, and that's the things that we want to talk about. So accelerated patterns of out-migration. You're seeing a lot of folks left New York City. I'm going to get very specific about that. Boston, Los Angeles, San Francisco, New Jersey, Chicago, all lost a lot of people. Not hundreds of thousands of people, but millions of people in the last 10 years. And we'll talk about that, and we'll talk about where they went. So you'll see predominantly they've been going to the Southeast, the Sun Belt states, Texas, Arizona, and Colorado. So this map here, I'm just going to move this through quickly because it's not that easy to read the numbers on there, but the darker states are the states that have had the highest overall population growth. Now that includes immigration, legal and illegal. So we see some of that here at the border. And so you'll see Texas, for example, has grown a lot in the last 10 years. Some of the other leaders right behind it are Florida, Nevada, Arizona, Atlanta, South Carolina, and so forth. And we look at the best tax climate states. Texas right here, this is corporate tax, business taxes. So Texas is number 13, Florida is number 4, Wyoming is number 1, Nevada number 7, California number 48. So one of the worst tax environments in the country. New York number 49, New Jersey number 50. The worst tax environment. So these are the things that are driving these migratory trends at one level. Now look at these specific cities here I'm going to talk about, and I'll give you some interesting comments. One of our investors is the city of Boston. So I presented this slide to them when we were talking to them about investing in one of our funds. And one of the trustees said, do you realize, Steve, that in the last 10 years, Dallas, Texas added more jobs, 845,000 jobs, more jobs than the entire population of the city of Boston in 10 years. And if you look at some of these numbers, my print's a little smaller down here on this smaller screen, but Atlanta added 545,000 new jobs in 10 years. Austin added almost 300,000 new jobs in 10 years. For a town of that size, that's amazing. So these are the things, these are the cities that are basically growing the fastest on multiple fronts. And why? Because they're doing a lot of the right things. They're focusing on what's important to families, individuals, and businesses. This next slide here talks about employment growth. To be fair, we only took it through to 2020, but everything above the green line, those are the fastest growing cities in employment growth across the country. The national average, you could see, has been declining over the last 3 years from 2018 down to 2020. But everything above the green line, Denver, Nashville, Atlanta, Austin, it's because of the MSA doesn't reach a certain amount of population. That's the only reason it's not on there. Phoenix, Orlando, and of course Dallas. And some of the places that are small are below the national average, again, New York, Chicago, and Los Angeles. Cost of living, this is the cost of living index. We see more and more things influencing the cost of living. Obviously, inflation, gas prices, all these things are on everybody's mind, and they should be. So what that does is it makes any particular family say to themselves, how can I get more mileage out of my income? Where can I live that it's more affordable for me and my family so that we don't have to compromise our quality of life, the things that we do, the things that we love to do. So you could see on here, for example, New York sets the index at 100. So basically, if I wanted to live in Austin, I could live in Austin for 35% cheaper than living in New York City. If I wanted to live in Dallas, it's almost the same. It's about 32% cheaper to live there than it would be in New York City. So these things are important drivers, and these are the things that families discuss at the dinner table and have been driving some of these migratory trends. Now, if you look at this chart here, the top right chart is the domestic migration by state. So this just takes into consideration people moving from one state to another. So if you look at the last 11 years, Florida has taken in 1.67 million people from other states in 11 years. Texas is 1.61 million people from other states, followed by Arizona and North Carolina. If you look at New York has lost almost 2 million people in the last 11 years, and this is, remember, not taking into consideration what's happening right now, but I live in Florida. I live in Naples, Florida, and I watch the amount of people and all the different license plates, which I'm sure you see here in Texas as well, coming to your states to evaluate permanent relocation. Illinois, you can see, also losing a lot of folks. But if you look at the bottom left, this is over 26 years, New York has lost 4.4 million people to outmigration. Illinois, 2.1 million. California, 3.7 million to outmigration. The green states there, or the green areas or regions, are where all the activity is happening, where people feel they're finding affordability, business-friendly environments, and so forth. So as you can imagine, when you have an outpaced amount of people moving into certain regions and certain states and certain cities, it creates a higher level of demand for the existing real estate that's in there. Now, what's happening at the same time over the last 7 to 8 years that a lot of this has occurred is the cost of new construction has gone up by as much as 45 to 50% in the last 7 years. So what that does is that dampens the banks or the lenders' appetite to deliver or lend for speculative development, meaning excess new supply that may not, it may or may not be absorbed, but the reason they're reluctant is because it's so much more expensive to deliver it and to build it, not to mention the delays in timing, the delays in supply chain, the shortages of resources or labor force that has been going on in the last few years as well. But what happens is when you do deliver it, because it costs so much more, you have to lease it out at a much higher rate, usually significantly more than the amount of lease rates for existing product that is comparable product that may only be 8 to 15 years old, let's say, on average. Same type of amenities, great location. If the buildings are well maintained, people say, I'll go with the older product rather than pay as much as 35 to 50% more in rental rates or lease rates for that new product. So that's holding off speculative development, which further compounds this situation, because especially in these markets where all this demand is happening. This is an example of the states that are receiving domestic migration. The blue states there are the ones that lead in domestic adjusted gross income. So one of the things I talked about was the financial strength of a market or a submarket, a state. So these blue ones on top, for example, Florida, and this is not, we were trying to be really fair, so we did not add the COVID impact yet. So we will wait, and this will put these numbers at even more alarming ranges. But Florida, for example, added $17.7 billion in adjusted gross income. And so, that particular year. Texas, at that time, $4 billion, and we're actually waiting on the new numbers because they tend to be slow. This is from the Census Bureau and the Department of Revenue. But if you look at the bottom, you can imagine California, New York, again, Illinois, New Jersey, they are all in the red, and the reason they're in the red is because businesses are leaving and people are leaving. So when businesses and people leave those states at these alarming amounts and these alarming rates, the tax base starts to go down and down and down. And so when you have taxes that go down, corporate and individual taxes going down, then you have two options. You can cut services, right? Seek federal assistance, or increase taxes for those who stay, which further compounds the problem and further motivates people to consider relocating. So these migratory trends and the drivers behind this movement of this stuff is very, very important to understand. As a real estate investor, we're very, very data-driven at TerraCap. So our goal is to buy the best locating remaining vacancy in the cities that are growing the fastest and that have the highest demand. That's the goal if you take this data, because we know where the people are going. We now are starting to understand why they've been going there, right? So the issue is take advantage of that in an investment thesis. So the cost of new construction, I mentioned this to you. Look at that chart. This starts at February 2014 through February 2022. And now, poured concrete index is the general index for commercial construction. And it's up basically 55%. So this is holding off speculative development because the cost of construction in 7 years is up 50 to 55%. So let's talk about what's happening, what's really happening in some of these markets. So the national economy, as we've seen, has regained almost all the jobs, depending on which statistics you look at, but we're pretty close to regaining all the pre-pandemic jobs. But New York City has only regained 35% of those jobs that were lost in 2020, just 2 years ago. So it's estimated that New York won't recover till 2025 with regards to the jobs. So there's a lot of other things that drive these factors that I didn't bring up earlier, and that is crime. I just had lunch with some friends from New York, and they were telling me about how they personally, in the last week, have witnessed robberies coming out of CVS's and Walgreens and all these other stores where they have the new rule that as long as you steal less than, I think it's $950, it's not a felony, and you can keep doing it day in and day out. You know, these types of politics are giving families concerns and residents concerns, because guess what? Their kids are watching this, right? Not just them, their kids are watching this. They're watching violent crimes go up. A lot of these things are concerning and alarming to families. So it's impacting the big cities, and a lot of it has to do with policies that are being implemented. So look at this. New York City avoided a drastic spending cuts and tax increases. This was how they sheltered it. They needed $22 billion from the federal government just so they wouldn't have to increase taxes, because they didn't want to lose more people that were already leaving at alarming rates, and they didn't want to lose more businesses that were already leaving. So they got $22 billion from the U.S. government, and no one ever heard about it. Everyone's like, wow, nothing really happened on the tax side. That's why, because they got it from the government, okay? So it's the first time in history also that New York zip codes, high-profile residences. New York always had some zip code in the top 20, multiple zip codes in the top 20 most expensive residential areas in the country. Not last year. And they went from 22, they had one zip code that was, I believe, Upper West Side was ranked number 22 in 2020. In 2020, it dropped to number 93 in 2021. Why does that happen? Because there's no demand. People are leaving. Now, don't get me wrong, I love New York City, and I love a lot of these big cities like San Francisco and Los Angeles. They're beautiful, and they've got a lot of past and future potential. But these things, we need a catalyst needs to happen to reverse these trends. Because when you get down to human nature, what do people usually do? They talk to their aunts, their uncles, their grandparents, their friends, their families. What are you doing? Where are you moving? Why are you moving? And then they go where their comfort zone is. And that's what makes these things get more and more legs and start to accelerate. So what do they look at? They look at corporate taxes. They look at regulations. California, for example, is riddled with regulations. And I will talk about the amount of impact that that's had on that state. Obviously, taxes, I had lunch with some friends from New York, and they said that their tax rates in New York City, if you're in the higher earning bracket, could be anywhere from 55 to 58% if you live in the city. So almost 60 cents out of every dollar they make, 55 to 60 cents out of every dollar they make goes to the government. After a while, that just doesn't feel good. So I said, what's the cost of today? And one of them owns an apartment unit, and one of them is renting an apartment unit. And I said, in today, and we'll get into the affordability in other markets, I said, what is a good quality but not crazy amenitized apartment, one-bedroom apartment in New York City rent for? And they said $3,000. I said, I'm thinking to myself, boy, you can get a lot more for that in Florida or Texas or Georgia or the Carolinas or Arizona. And I said, what's a two-bedroom cost? $7,000 to $8,000. Do you know what kind of house you can get for $7,000 to $8,000? I said, $7,000 to $8,000. They said, yeah. And they know because they're in the market. So these are the things, affordable housing these are also driving migratory trends: quality of life, top-tier universities, talented workforce, and safety, as I mentioned earlier. So let's look at Texas. Why is Texas so awesome? I've lived in Dallas 3 different times. I started my first business ever in Dallas in 1995, and I sold it in 1997. Actually, I sold it in 1996. It was 22 months old. The business climate was so great that I took a business from 0 employees, I was the #1 employee, to 155 employees in a period of 20 months and sold it to a public company out of Denver called Cyber. And that happened in less than 2 years, because this is a can-do state with a can-do attitude and a can-do business environment. And anybody who's coming from the polar opposite of that and comes here says, what have we been waiting for so long for? Why aren't we here a long time ago? So we look at places like Texas, always a leader in top, Fortune 500 appeal. But when we look at some of the major relocations, Tesla, Hewlett-Packard, Oracle, Seabury, they all came from California. And these are big multi-billion dollar corporations. So since January of 2018, California had relocations exceeding 107 companies, nearly 5x the number from any other state, meaning California to Texas. So we do a lot of research, as I mentioned. So before we went into Phoenix, Scottsdale a few years ago, I spent every 6 months, I'd go out and meet with the Economic Development Council, the head of the Economic Development Council. And from 2015 to 2019, those 4 years, that city, Phoenix, Scottsdale, you can call them a combination there, Phoenix, Scottsdale, took 304,000 people from California directly into Phoenix, Scottsdale. And with that came 76 businesses that they were aware of, that they took right out of that state. And here's another example right here, which we talked about with California to Texas. So these are alarming rates. So what's going to churn that around? There has to be major policy changes. There has to be other things that make sense for families and individuals. And so, I'm not sure what the catalyst will be once you have the momentum like this happening. And then you have the success stories that come out of places like Texas, Florida, and Georgia. So just going to go back here for a second. Yeah, I already talked about that. So if we look at Georgia, for example, they added 1 million people in the last 10 years. 1 million people. Remember, Boston is at 695,000 total people. Georgia added 1 million people. They have a lot of things going on there. Google, Facebook, Microsoft moving there with not corporate headquarters, but major corporate locations. The Georgia, I don't know if you knew this, now exceeds California in the movie industry. They have more movies and more money spent from the movie industry in the state of Georgia than California. So California, I apologize if anyone's here from California, but things need to change there because these trends are not going to reverse on a dime. They're going to keep happening. So some of the things that put this also into perspective when you're a real estate investor or if you're a tenant, right, and you want to rent property. So we all know that right now in real estate, the 2 favored asset classes are multifamily and industrial, or flex industrial, warehouse, or straight up industrial, procurement, fulfillment, and so forth. So Orange County, for example, if you want to lease straight basic industrial space, right, in and around the port or the Inland Empire, the average lease rate is $15.21 per square foot. In New Jersey, $12.58 per square foot. Houston, $6.11 per square foot. And by the port of Savannah, $5.37 a square foot. And guess what? Off of the coast of Georgia, you don't have hundreds of ships waiting in line to deliver their goods, right? So it doesn't take long. Again, if you're trying to get ahead of these curves and trying to do an investment thesis, could you imagine how frustrating it is if you have cargo ships that have tons of containers of your products sitting out there for weeks on end, when you could actually drive that same tanker through the Panama Canal all the way around to Savannah and be there in 7 to 8 days rather than waiting to 3 to 4 weeks. And guess what? You could lease space at 1/3 the cost that you're leasing space over there. But more importantly, when you think about the other component that people don't dig into a lot is the supply chain, right? Logistics and distribution. So if I'm a truck driver unloading these tankers, right, and delivering these goods to the short-term, delivery points or the last-mile delivery points, if I'm in LA and came in through Long Beach Port or LA Port, I can only do 1 to 2 turns with my truck delivery per day because of the amount of traffic. There's just too much traffic, right? If I am that same independent truck driver and I'm in Georgia, I can do 5 turns a day, okay? And I get paid by the turn. So guess what's happening to those companies that are in LA and they have the truck drivers? And remember, keyword independent. That truck driver says, Mr. LA firm or Mrs. LA firm, you're going to pay me for 5 turns, even though I can only do 1.5 for you to 2. But you got to pay me for 5. If you don't pay me for 5, then I go maybe over to Savannah and I get my 5. Right? And I feel better about myself because I'm not just sitting around in traffic all day. So these other factors will drive businesses, in our opinion, to more affordable ports. And that's some of the things that are going to happen, because if you look at the population in the U.S., because a lot of the migratory stuff we're talking about is population, 70% of the U.S. population is east of the Mississippi. So now if you're thinking about that, you're saying, why am I paying all these rents over here to serve a smaller population when I could pay 1/3 of the rent and I can get 4 to 5 times the turns for my truck drivers and deliver that much more product? It won't take long till you start seeing people leaving those ports and looking for industrial product and industrial warehouse on the East Coast. These are just some of the stuff you want to think about. So we look at Phoenix. I mentioned a lot of this earlier. I won't spend too much time on this slide, but you could see just from California, I mentioned that 305,000. It was 76 corporations, but they also received in Phoenix 73,000 from the state of Washington, 47,000 from Oregon. That's in a period of 4 years. And the residents, that's 425,000 residents, okay, they gained in those 4 years from those three states. That's more than the total population of the cities of Miami, Minneapolis, and Raleigh in a period of 4 years. It's pretty amazing. So now you can see where you want to be investing in real estate. And as a real estate investor or as a trustee, when you're being approached with a real estate investment, I think what you want to ask that investment manager is, what markets are you investing in? What are the demand drivers? Is there enough demand there to push the lease rates and increase the net operating income? Or are you in a market where there's flat to no growth? Because if there's no growth, I can't increase the lease rates, I can't increase the net operating income, so I can't sell it for a higher price then, because in real estate, people buy cash flow. That's what they're buying, is the lease terms and the cash flow. California, this is pretty alarming also for California. Sorry for all the bad news if you're from there. But the population in 2020 actually declined by 182,000 people. So for 30 plus years, more people have left the state of California than have moved to the state of California. Okay? Residential outlook. So one of the big challenges we hear about is affordable housing, or the lack thereof affordable housing. Part of that has to do with the cost of new construction and the demand, right? So there's a big gap or a delta between what people can afford as a percentage of their income versus the cost of building something net new today, right? And that's what's limiting the optionality in housing. And that's why, for example, just 4 or 5 years ago, the average inventory was 1.2 million houses available for sale. It's now around 500,000 in the country. And when things go up for sale, if it's an attractive location, attractive property, guess what? It's being sold above asking price. People want cash-only buyers. It's definitely a seller's market. It's definitely not a buyer's market. And why is this continuing to happen? Again, the cost of new construction doesn't show any relief in the future of flattening or coming down. Things are taking longer to build, supply chain, as I mentioned, labor shortages, and cost of materials, and dependency on other countries delivering products that we need here. So that's going to continue to hold that off. So is that good for real estate investing? It is good for real estate investing because we won't ever have oversupply. And that's what creates major crashes in real estate, is when there's too much product and not enough tenants. People start selling for less than the value of the properties, or certainly less than the value of replacement cost. So that's not going to happen anytime in the near future because of those numbers I showed you on the cost of new construction. So multifamily, this is really interesting. Because of the, as an investment manager, if you're developing multifamily because of the cost of new construction, you're probably developing higher quality, what's considered Class A multifamily product, okay? So this is the proof in the pudding. So since 2015, so in the last 7 years, of multifamily apartments that were delivered, 2 million were Class A, and only 315,000 were Class B. And Class B is your typical workforce housing, anywhere from $1,200 to $2,400 a month on average rents. Class A, depending on the market, you heard about New York, right? That's crazy, you know, $3,000 for a one-bedroom, $7,000 for a two-bedroom, somewhere in between there. In Atlanta or in Texas, for Class A, it's usually, you know, anywhere from $2,800 up to $4,000 for a 2 or 3 bedroom unit. But what's more concerning is there's less and less Class B workforce housing being built. So what does that create? That creates competition for that type of product, because those who can't afford Class A anymore, they used to be able to, but those that can't afford it anymore are now looking to Class B. But what further compounds that is, remember all these migratory trends we just talked about, all these people, millions and millions of people going to certain markets? They're coming from markets that were more expensive. I gave New York as an example, right? So they come down to Florida or Texas. You could get a 3-bedroom apartment in North Naples, Florida for $2,700. Remember, you can get a 2-bedroom in New York for $7,000. So they come down, they're happy to pay more than local rates because they're still saving money. And that puts pressure on those that are used to filling those apartments because they can't afford it anymore. So there's a lot of issues going on with this. I'm going to talk about a little bit here. This is more of a high-level real estate investment thing, but you should always think about this, that if you're not pushing lease rates higher than inflation, you have basically a net value loss in the asset. So for example, if we look at multifamily rents in certain markets versus other markets, in 2021, as of August 2021, okay, New York City year-over-year rent from August 2020 to 2021 was up 4.5%. That's how much they were able to increase their rental rates in that 1 year during the middle of COVID stuff. Tampa, that same year, went up 25%. Remember, if year-over-year inflation was 7% and market growth was less than that, then you had a negative real return on that asset. So a lot of the core markets and the core property owners during those markets, you know, are facing, you know, extended recovery time frames. I'm not saying they won't recover, but they're facing extended recovery time periods where markets like Tampa, Atlanta, Charlotte, Austin, Dallas, Denver, Phoenix, Scottsdale is the exact opposite, the tale of multiple cities. So here's some case studies. This is a real asset that our company bought, only 2 years old. We bought it in June. This is called Versal. This is in Bonita Springs, Florida. Bonita Springs, Florida, for those of you who don't know, is directly adjacent and north of Naples, Florida. So somewhat a land-constrained area because we have the Gulf of Mexico to the west, and on the right side, about 30, 35 miles in are the Everglades. So there's not a lot of land to have the sprawl or the urban sprawl. The growth goes north up towards Charlotte and Sarasota County. This apartment, we bought it in June 2021. We paid $70 million for it. When we bought it, the rents were $1,647 per unit. Look what the rents are now, $2,549. It's an increase of almost 55% in less than 1 year. This is what's happening in high demand, very popular markets. Now, as I mentioned earlier, those that are moving from New York are saving money and feel good about paying that rent, but those who are paying $1,600 a year ago obviously don't feel that good about it. But the whole market has moved up. It's not, any individual developer, any individual investment manager. The whole market is doing that, and we still can't address the demand. These apartment complexes are between 98 and 100% occupied, and forward leasing is usually always at 99 to 100% occupancy. So it's pretty amazing. This one here, this is in Orlando. This is Bridgewater Residences. We bought that, 344 units, a year and 2 months ago, $52 million acquisition, $1,117 were the in-place rents. They are now $1,481, and that is 37.2% increase in basically a year and 2 months. Where, as I mentioned earlier, in New York, they saw 4.5% a year ago. This is the type of stuff that's happening in Austin. It's happening in Dallas. It's happening, all over the popular states where people are going. The last slide I'm going to show you on the case studies, this is really interesting because a lot of people will say to you, the asset class that's in question or that's suspect is office, right? Now, a lot of people will want to drink that Kool-Aid on a national level and go, oh, well, I would never buy office. And I mentioned this to you earlier. We bought this in October 2020 because I'd mentioned I'd spent the last 3 years talking to the Economic Development Council in Phoenix and Scottsdale, and I was watching closely the amount of in-migration from California and the corporate relocations, and I compared that to the available office space and future availability of office space or deliveries of office space, which were basically non-existent, and I knew the demand was going to significantly outpace the supply. So this is on Camelback. For those of you who know Phoenix, it's right in between the Biltmore Mall and another mall, really great location. We paid, this is what it looks like on the inside. You can see it's highly amenitized, has a courtyard feel to it, beautiful Class A building. Ironically, we bought it from a company based out of Newport, California. We paid, it's 333,000 square feet. We bought it for $103.5 million, and the average rents when we bought it in October of 2020 were $30.67 a square foot. They are now, this is not on here because we show the average lease rate was $38.33 a square foot. That's what it's moved to, right? This is Class A office. Right? So Class A office is not dead if you're in the right location with the right type of product. You can actually do really well with it. It's now at $40 a square foot. That's what we just signed a lease for. I think it was last week. But an increase in rents of 25% in a period of a year and a half, where the average office lease rate increases pre-COVID, pre all the pandemic and work from home stuff, was averaging increase on an annual basis with about anywhere from 2.5% to 4%. Or the annual bumps you'd get in your lease rates, 25% in a year and a half. So it is the tale of multiple cities. You really should do the research and understand where the people are going, why they're going there, why the businesses are going there. And then as a real estate investor, you want to be, very, very selective of what you buy, but all asset classes in this environment can do well if you're in the right location with the right product. And that concludes this presentation, other than a recap of the stuff that we've already talked about, which is these things are not going to change. Rising land costs, inflation impacting raw materials, shortage of materials and labor, and then an increase in government regulations, which are adding additional expenses to development, which again is going to further that gap between new construction lease rates and existing comparable product lease rates. And as long as that gap is wide, investing in real estate is very logical and makes a lot of sense. Have any questions? Whoa. Yes, Kurt.
Two questions. So you did show us the per square footage prices that you just made a lease on, but what's the occupancy of those office buildings? And then the second question is, do you think the Great Resignation is going to cause for more increased cost in construction and new construction?
The answer to the last question is yes. And that's why I say I don't see a catalyst that's going to reverse the increase in new cost of construction. And the occupancy rate at that office building is 98%. Otherwise, we wouldn't be able to push the lease rates. So, for example, if it was at, let's say, 85%, that's probably an indicator that there's other vacancy in that submarket that's as good or better, and other people might take that as opposed to ours. Yes, sir.
I was wondering to what extent your projections take into account infrastructure constraints, like near and dear to our hearts, although we got through a winter here. I mean, if we have another week-long statewide blackout next time it gets cold, that people aren't going to want to come here as much. Or if you've ever tried to drive through Austin any time of the day or night,
I've been there when the flooding's been there. Yeah, no. Infrastructure is really important, and the interesting thing about it, but if you look at it from a practical perspective, is a lot of the infrastructure that went into place well predated the anticipated growth. So, for example, when I go to Miami, all you see in Miami is these skyscrapers going up, right? Because there's no land. They abut the Everglades. That's a hockey team. The Everglades on the west side, and then on the east side they have the ocean. Right? And their infrastructure was put into place in the 40s and the 50s. They never thought Florida or Miami was ever going to see this type of growth or this type of demand. And the same thing for all these cities. So it's going to get taxed more and more, not meaning like taxed financially, but just too much usage. And the challenge is the way the laws are and the rules and protectionism, which is good, is you can't expand beyond when you're already abutting, buildings, right, with the highways or the main arteries through a city. So I think you would have to start stacking, for example, if you're talking about roads, to deal with the population, things of that nature, because you can't, build a road into someone's building and already have, abutting to the building. So it's, Yeah, I mean, I think what will happen is you'll get more of the growth will start overflowing into the adjacent cities or towns. I mean, we look at Dallas, for example. I mentioned I'd spent a lot of time in Dallas. I actually lived there on 3 different occasions in my career. And I remember in the 90s, like Addison was like, pretty far north, right? And then then it went to, McKinney and then Frisco, or Frisco, then McKinney, and if you look at legacy out there, it's just everything just keeps going north and north, and that's what will happen. And then now the city planners now know what type of in-migration and growth to expect. So when you see the new roads go in, you notice there's a lot more spacing wherever they go in. But what will happen is something called dislocation, and that means that what used to be the popular city center area that's now too old and has challenged infrastructure, people will eventually over time move to the newer areas, and those older areas people will start moving away from and out of because they want to be around the new energy and the new product, and that's misfortunate because the values of those older areas will start to go down over time, and that's what just happens. Any other questions? Yeah.
Just one question. With the pickup in interest rates, what impact do you think that's really going to have? Does it slow things down, or does it
So the interest rates, it's a great question. So one thing that a lot of people get concerned about that, but if you look at correlation between interest rates and cap rates, they're pretty non-correlated. So it really becomes an issue. Interest rates affect the debt and they affect the overall return, clearly, but there's not a lot of impact between, or correlation between interest rates and the cap rates. So the value can be maintained. Obviously, it's a sensitive balance, and once it gets to a certain level, which it's creeping towards, you could be put at risk as far as the overall returns. But one of the things that we've relied on consistently is if you look at the last 15 years of real estate investing, they've been talking about interest rate creep for a long time, right? And that's the million-dollar question always is, when are they going to go up? How fast are they going to go up? We kept buying floating interest rates because we felt that the entities or the government entities that can influence interest rates, the Fed, and they're supposed to be independent, but we all know that when you hire the Fed chief, it's not probably too independent, that those interest rates are being kept down and artificially held down because the biggest loser if interest rates go up is corporate debt, government debt, and people that influence the Fed don't want to see that go up at too alarming of a rate. Now, when interest rates go up, that also means that it's a sign that the economy is stronger, or the view is the near term is going to be stronger. So when that's happening, you have a little bit of a balance too, because at the lease level, you can push lease rates. And that's why you're seeing some of this lease rate movement as well, in anticipation of interest rates going up and in a stronger economy. But the most important thing is there's not a lot of correlation between interest rates and cap rates, and that's the value of what you're buying. Any other questions? Yes, sir.
When you talk about the migration and for multifamily, how you're able to increase rents, they're willing to pay, it's cheaper than wherever they came from.
Right.
In theory, wouldn't their salaries decrease once they move to a cheaper state, or what happens there?
But that's interesting because I think a lot of the movement that we've seen, at least short term, is a result of people being allowed to live wherever they want to and work from home. Right? To a certain degree. I don't know what percentage that is, but I know it is a percentage because I see people that, there's a guy actually, he lived in a beautiful condo in Newport, California, and his company, Irvine Company, they're about $120 billion real estate investment company. I think they're the largest privately held. He was living in Naples, and he contacted me and he said, hey, do you want to get together and talk real estate investing? I said, sure. He was living in Naples because he could work, the company said you could work anywhere you want. So he moved to Naples, had a place in Naples, already owned his condo over there, but was living, 85, 90% of the time in Naples, fell in love with Naples and the lack of regulation, the lower cost of living, and he moved to Naples.
But when you're modeling these deals, are you modeling in the sense of that's going to be the long-term outlook, or is it the short?
So here's the thing. The amount of influx that we see, right, is way outpacing the current supply. And remember, there's not a lot of, if any, new supply or any significant new supply. So we balance that where we know that the inbound is much greater than even if there's a pullback. So even if there's a pullback of 20 or 30%, it would still be fine in these hyper-growth markets. You couldn't afford a pullback, for example, in New York or Chicago or a place like that. They're already challenged. But in these hyper-growth markets, you could afford a pullback because there's no new supply. Go for it. No, you were going to clap. Any questions? Any more? I'm really happy that we got this room this full after lunch. I really appreciate y'all coming. Thanks so much. Really enjoy it.